Please welcome to the stage Blend co-founder and CEO Nima Ghamsari, Upgrade co-founder and CEO Renaud Laplanche, Intuit vice president and business leader for QuickBooks Payments and Capital Rania Succar, and Bloomberg television anchor Caroline Hyde.
Welcome all. We're going to get your juices flowing. We're just before lunch now, so get your appetite ready. Start asking some questions. We want audience participation because we're at the cutting edge of millennial lending right here. So don't worry if you're not looking at us. Look down at your phones, get tweeting, hashtag STYT. Give us your views, your perspectives. And also, we're going to get their juices flowing, first of all, by seeing who we're dealing with now. Are we preaching to the converted? Are you all already out there with your new ways of borrowing in terms of the internet, or are you not? So I want to ask an audience question first. Do you prefer, would you take a loan from a bank or a startup? So take out your mobile. We want to understand what your viewpoint is. So are you, at the moment, would you prefer to get a loan from a bank, or option 2, a startup? So give us point 1 or point 2. We'll see whether the technology at a technology conference works. You can do it, mobile. And while we get your viewpoints in this, I'm going to ask each of our wonderful panelists here, starting with Nima, to give us your pitch in terms of what it is that your company does. Let's kick it off with Blend.
Sure. Hi, I'm Nima. Our software product is a white-labeled mortgage platform that we primarily license to banks. And what we do is we make the process of getting a mortgage digital, data-driven, simpler, so you can get it in less friction than you would in the previous world.
Renaud at Upgrade.
So Upgrade is a consumer credit platform. So we're trying very hard to make credit more responsible and more affordable for US consumers. And we're doing so by using a very modern technology platform that operates at a lower cost, and we pass on the cost savings to consumers.
And Rania.
At QuickBooks Capital, we're solving one of the biggest challenges small businesses face, which is access to capital. And more than 70% of small businesses need it, and only 1 in 5 get the capital they need. And we're solving it through some of the most advanced data technology and data science in the industry today.
There we have it. And this is what we're battling with. At the moment, only 40% of our audience would go to one of you guys to be able to get their borrowing. 65% are still going to the big banks. So Nima, kicking us off with, what are you offering that the banks don't at the moment? Or indeed, how are you working with the banks? Because you've got an interesting perspective. You're white labeling your product for the banks. Are they getting it? Are they getting on board with FinTech and the cutting edge of lending?
Yeah, when we started the company in 2012, and we said we're going to work with all the banks, everyone thought we were crazy. Fellow panelists were saying we can topple the banks, we can take over the banks. And we said, let's work with the banks, not because there's something necessarily right or wrong about being a bank, but because this technology could touch millions of people. And so we launched our product in 2015, and the core innovation was a lot of the understanding of whether a person can repay a loan comes from collecting bank statements, pay stubs, W-2s, and we felt that if we were able to aggregate that data instead of collecting those documents, we could make those decisions in real time and offer that to more people. And so now we do about $1 billion a day in loans going through our platform and growing.
$1 billion a day in loans. Let's bring up a Bloomberg chart now of just showing how much we're already starting to see FinTech encroach upon the big banks in terms of how much they're offering consumer loans within the space. We are starting to see the FinTech companies really ramping up. Look at that in the purple. We've got 36% overall of personal loans really are being taken by FinTech. We were just hearing from some of the banks' earnings that we're getting this week saying, we're worried Bank of America Merrill Lynch is seeing FinTech encroach on its space. Renaud, how are you encroaching on the bank space?
So I think it really comes back to the use of technology and a more modern, simplified business model that doesn't rely on having a branch at every street corner, but instead relies on delivering credit in a very efficient way and taking the cost of operations down. It doesn't mean that the banks are shut out of the process. In fact, banks have come to participate onto platforms that are part of the marketplace lending industries, such as Upgrade. So Upgrade has a very low cost of operations, but the banks have a very low cost of capital. So very often we see a situation where we have a customer coming to us and we handle underwriting, servicing, but the capital comes from a bank.
I see. So do you see the bank as your competition, or do you see startups as your competition?
So it's really both. I think banks can be both competition or partners, and same thing with fintech companies. I think we are all sort of deconstructing and reconstructing that puzzle in different ways. And I think the key factor of success for both fintech companies and banks is really to put together the best solution for consumers. Without ego or without trying to sort of necessarily dominate anybody else, but rather I try to think of the consumer first and say, okay, who has the best technology, who has the lowest source of capital, who has the most sort of sustainable business model, who has the most predictable way of doing it, and sort of reorganizing that industry based on best-in-class components, I think is a key factor of success.
Upgrade and Blend are very much looking at the consumer, but with Intuit QuickBooks, you're looking at the small and medium-sized enterprise. How much are we seeing small businesses being fueled now by fintech rather than the banks?
FinTech is largely focused on the underserved, and that's exactly where we're focused today. So today, as I mentioned, there's a huge problem where small businesses can't get access to capital. And that's because, unlike in the consumer world, there isn't a very strong small business credit score where it's very easy to underwrite a small business efficiently and effortlessly. It's just too costly historically for a small business to do it. And so the innovation is all around data, new sources of data that allow new lenders to be able to look at a small business that's very young in business, sometimes less than 6 months, less than 50,000 in revenue, these new businesses that need it most, and to try to figure out how creditworthy they are. And that's an area where Intuit is uniquely focused on innovating, given the unique aspect of the small business ecosystem that Intuit has, being the largest small business ecosystem out there. So the ability to understand with precision the existing financials of a small business. How much are they sending in payroll? What do their expenses look like? And of course, future expenses as well through incoming invoices and future income. So for the innovation right now is about getting access to capital to the underserved small businesses.
And what are you finding within the small businesses that some banks just can't realize? Like, we see so many small businesses go out of business. For what reasons that perhaps isn't just that they've been blowing all their cash too quickly? There must be some seasonality, for example, to the whole business.
Yep. It's like I mentioned, it's just as expensive to underwrite a loan for $100,000 as it is for $1 million for a bank. So it's just not economically viable given traditional ways of underwriting. And so the data within QuickBooks, the transactional data, that unique expense and revenue side of things, gives you the ability to understand unique trends like seasonality, as you mentioned, Caroline. So if a small business today is growing because there's growth year over year, they're just in their strong seasonal pattern. That helps us really predict future cash flows. Similarly, the ability to understand how much a small business has in open invoices. There's 240 million invoices sent a year through QuickBooks. If you're a lender, that's incredibly valuable information to understand future cash flows. And not only do you know how much there's in open invoices, we've built machine learning models that are able to predict how likely that invoice is to be paid back, by when, because you can understand the patterns of how those invoices are paid back. Again, that can work very favorably for small businesses in being able to fund them for these loans.
Nima, I think it's interesting that we've heard from Upgrade how they're seeing the banks as the competition as well as the startups. With Intuit QuickBooks, we're seeing how that they're just offering a product that the banks, it doesn't make economic sense for them to do so. With your company, Blend, you're bringing $1 billion a day now, say you're helping underwrite mortgages with the banks. How are you expanding your product portfolio at the moment? Because it must have been incredibly hard to get the big banks, first of all, to get into bed with a startup such as yourself.
Yeah, I mean, it was a fairly high-risk endeavor for them early on. Nowadays, probably less so. But I think, to Rania's point, it's so expensive to underwrite these loans. Underwriting one mortgage loan costs a mortgage lender about $8,000 to $9,000, somewhere in that range, which is 4 to 5 points. And it's very expensive. It's almost in some cases now they're losing money on doing the mortgage because they want that long-term relationship with the customer, which I think makes sense, similar to small business. And I think a lot of the same a lot of the same things she was talking about with data and being able to understand cash flow streams and transaction streams, that applies to small business, that applies to consumer in a lot of ways. I think it doesn't just apply to mortgage, it applies to unsecured personal loans. I'm sure you're doing some stuff there with in your unsecured space. It applies to auto loans. It applies to pretty much anything that you have to understand the person's ability to repay something. You want to look at their history as a primary indicator for that. And so our technology is sort of uniquely positioned in some ways to do that, because we do that for one of the more complicated products in the market, the mortgage. And so we think we're going to take that to other product lines over time for the banks as we expand our reach.
We're starting to see you all encroaching on the big bank space, as we've seen, or indeed working with them and helping them expand, as Nima's company is. I want to get another bit of audience participation now, because we keep hearing at the moment, in the earnings season in particular, about the credit cycle, perhaps the concerns that we're starting to hear about the credit cycle. We heard it from Marcus, which is the consumer lending product coming from Goldman Sachs. Let's get your take on how you think fintechs are currently set up for this credit cycle. Are you worried about fintechs as we head into the new down cycle? Yes or no? Give us your sense. And as you're all voting, I want to first of all hear from Upgrade about how you're setting yourself up from a consumer, because you are wanting to replace the credit card. You're really getting into bed with the consumer. Are you worried about where we are in the consumer credit cycle?
Yes, no, so we're very aware of where we are in the credit cycle. I think we're now in the sort of second longest period of economic expansion in US history. So it's not going to last forever. We don't know if the next slowdown is a year out or 2 years out, but it's coming at some point. And so we've incorporated that situation into our underwriting and our credit policy in a way that probably puts a more focus on sort of shorter term loans. And cuts out a lot of the sort of subprime and big part of the near prime risk. It also puts more focus on cash flow, on free cash flow, and on ability to repay. Because at the end of the day, especially in the early innings of a slowdown, that's what's going to make the big difference. Are we attracting consumers who are living paychecks to paychecks and are very exposed to a slowdown in the economy? Or are we attracting consumers who have developed some savings, have enough monthly cash flow to make their loans payments, overpayments, based on where they live, based on sort of the affordability of any given city or state, based on sort of housing expense. Yeah. So the entire picture, we're trying to understand really how much cash flow is available, can they make their payment and acquire some savings, so that if they lose their employment, they have the ability to continue making payments before they find a new job.
How do you fight this then? 80% of our audience are worried about the startups situation ahead of this credit cycle. What are you saying to your investor base? You've been raising money for Upgrade. It's a relatively new startup. How are you confirming to them that they shouldn't be worried about you?
Yeah, so I think a lot of our investors on the platform, so the institutions that buy loans from Upgrade, are very aware of the credit cycle. And I think their understanding is the same as ours, which is when the economy slows down, default rates go up. They don't go to 100%. So there are still a lot of consumers who make payments. So we're very transparent about what we're doing to find the right type of customers, but also all the levers we have at our disposal. I think it's an area where fintech companies are actually better equipped than banks to react quickly to new signals and change the credit policy in a matter of days, adjust interest rates in a matter of hours, and find the clearing price in the market very quickly. Having that ability to be nimble, both in underwriting but also in servicing, and so redeploy customer service teams to collections and loan servicing in a way that's very quick and very efficient. That would be a lot harder for banks to operate.
Rania, you were telling us how you're using data to be able to preserve yourself from this sort of a situation and indeed deal with seasonality and issues with companies that banks might not be able to. When you're looking at providing to the SME community, is regulation currently a help or a hindrance to your business?
I think many of us feel in this space that there's opportunity to strengthen regulation so that there's less uncertainty about the regulatory environment and how to be able to proceed and build solutions for small businesses. We believe there's opportunity on the regulatory side to increase transparency for small business borrowers. One of the key stats is even small businesses who are tapping into new sources of capital from alternative lenders, the satisfaction rate with those sources is less than 50%. And that's because APRs aren't disclosed. Oftentimes in the SMB space, lending rates can be north of 50, 60, even 100%. And fees are very unclear and intransparent. So it's not clear that there's a prepayment penalty. If you pay back early, you lose out on you still have to pay all the interest. So that's an area we feel very strongly about given our history at Intuit and our focus on compliance and regulation and working for our small businesses where we always disclose the APR and the terms. There's never any fees at all associated with the loans. So we think there's an opportunity to strengthen regulation in the right way to help grow the market and therefore create more opportunities for small businesses.
Nima, we've only got a few minutes left, so I want to take it out to the audience in a moment, but privacy has got to be front of mind for you guys as well.
Yeah, I mean, I think as we talk about consumers providing this bank data, this payroll data, this transaction data, finding ways to keep that data safe, and actually, I think giving consumers the control back and visibility into how it's being used. There are some data sources about consumers that it's not clear how they're being used, and I think with this data, it's super important. And so we're building a way that we can allow consumers to kind of control their own fate and how it's being used and where it's being used and for what products it's being used at the institutions that we work with. And so I think that's critical going forward in a place where the data is of immense value to somebody who would be a bad actor.
So guys, are we going to have, and girls, hands up? We're going to get some microphones to you as quickly as we can. If you could introduce yourself as to where you're from. Yes, we have a gentleman just down at the front here. We can time for a couple of questions. Roving mics are at the ready. Here we go. Oh, we're taking one from the back first. Yes, thank you.
Hi, I'm a reporter with Bloomberg News. My name is Selena Wang. This question's for Renaud. It's been 2 years now since you left Lending Club. I just wanted to understand, what you've learned from that experience and subsequently the SEC settlement and how you're applying it to your new company.
Yeah, so I think the main learning from Lending Club over the first 10 years was that the business model actually worked. We were able to develop a great business based on that ability to operate at a lower cost, but also deliver a more responsible product for consumers. I think there's really an appetite, a thirst from consumers to develop their credit health. The same way a lot of us are eating better and are worried about how many calories we take in every day. I think that movement is going into financial health, credit health, and I think Lending Club has done an amazing job at replacing a lot of credit card debt with personal loans at a fixed rate, fixed monthly payment. It's a much better product for consumers. And so we've applied these learnings at Upgrade to add products like credit monitoring, credit alert, credit education, to really go one step further and help consumers get into even more responsible product and better understand their credit and empower them to manage their credit better. And Caroline mentioned instead of just refinancing credit card debt, we're also now moving into replacing a lot of credit cards and offering an Upgrade card that will be available at the point of sale and turns the balance immediately into a personal loan that pays down monthly at a fixed rate and with a equal monthly payment of 12 or 24 months. So a lot more responsible product than the traditional credit card debt. Now, other learnings from 2 years ago, I think one big learning is really establishing a compliance structure, a compliance culture in the company is absolutely a key factor of success for any fintech firm. And there's no, it should be on the agenda of every fintech firm, whatever the stage is, at the very top of the agenda of establishing a very strong culture of compliance with processes, with communications, with technology, that supports compliance and that makes compliance not a hindrance to innovation, but actually help compliance guide innovation and create a framework for innovation. And I think having both at the same time, a strong culture of compliance and a strong culture of innovation, is hard. But I think that was one of the learnings that it should be at the very top of the agenda.
I'd love to build on the credit worthiness comment, the credit score. We are actually working on a very similar theme from a small business perspective. So one of the big challenges small businesses face is more than 50% of them don't even have a small business credit score. I touched on it earlier. That's a huge barrier to getting access to capital. And they have deep interest in understanding what their credit score is and how to improve it. There's not a lot of awareness, and we discovered that through all of our customer research. So we are announcing tomorrow, we're announcing that we have introduced within QuickBooks a free credit score for small businesses through a partnership with Dun & Bradstreet. So they can come into their QuickBooks and see what their credit score is, see how the loan they're taking from QuickBooks Capital is improving their credit score. And we have found tremendous excitement from small businesses about this and a deep hunger to better understand their credit score. We see a world in the future where we can play a big role in getting small businesses a credit score that they can actually use to go to other lenders and get access to a loan. And so the world would look like small businesses being able to share the QuickBooks Capital credit score with other lenders to open up access to capital. And we've recently found through some of the data innovation we're doing that the QuickBooks score that we're deriving with our own internal data is in many cases more predictive than what we can see through third-party bureaus. So we are really excited about how this could change the game for small businesses over time.
One more question, I'm afraid. So short and sweet. Yes,
Hi, I'm Jeremy Strickler with Williams Wealth Management. I'm an independent. It seems that credit is driving, more than any other thing, the bifurcated economy where maybe 20-25% of the population can access very affordable credit because they're very credit worthy. And if you look at the banking system, you may be able to borrow money at 4%, but it's a binary question. And then if you look at the credit card companies, they can price risk. And so coming out of the financial crisis, they really didn't have any problems because they can raise interest rates to 28% and you've accounted for defaults. So I wonder if you can get more information and we'll get more differentiated pricing in your market so that we can extend credit to more people, but perhaps at higher prices. Is that pricing function going to come in as the information improves?
Nima, do you want to tackle?
Yeah, I would say there's two factors. I think probably the biggest factor to accessibility in credit is probably not pricing. I think there's a lot of people who are qualified for credit products, like a mortgage. The government has a lot of great programs in place to get people a mortgage at a low cost, but people just don't know. So like one stat, so one of the things that we do is we make the process of getting a mortgage mobile enabled. And as soon as we launch that, lenders would come to us and say, hey, I'm getting a lot of people with lower credit than usual applying. And it turns out a lot of people only have a mobile device in their home and they don't want to go talk to a banker in person. And so I think technology can open up the capability for anybody to find out if they're qualified, which is the first barrier. That's the very top of the funnel. And then absolutely agree with you on the data will enable people to have better, more variable pricing within those bounds of people who could be qualified for a mortgage, for instance.
I want to say thank you to the audience. I'm sure your stomachs are growling. Lunch is up next, so do make your way to go and grab your sandwich boxes or whatever we have on offer. I'm sure it's delicious. Before, please do give a huge round of applause to a fascinating panel. Thank you to Nima, Renaud, and to Rania. Thank you. Thank you all.